Day trading often feels like staring into chaos, monitoring 5-minute charts while every minor price tick drains your focus. On the other end, long-term investing requires tying up your capital for months or years, waiting for a macro shift to finally pay off. There is a highly effective middle ground. The 4-hour time frame filters out the erratic noise of the intraday sessions, while still offering multiple distinct, high-quality trade setups every single week. By the end of this video, you are going to configure a professional 3-chart workspace, and you will map out a high-probability swing trade from start to finish. You do not need proprietary software or expensive subscriptions to do this. You only need a standard charting platform and a blank chart of any major currency, crypto, or stock. Every 4-hour candle neatly aligns with the major global trading sessions: Asia, London, and New York. This rhythm allows retail traders to capture institutional momentum without sitting in front of a screen 24 hours a day. Step 1 is setting up your workspace. Open your software and divide your screen into 3 side-by-side panes for a single asset. Set the left pane to the weekly, the middle to the daily, and the right to the 4-hour. Then apply the 20, 50, and 200 exponential moving averages and an RSI oscillator at the bottom. We do this to perform multi-time frame analysis. Looking at the exact same asset across 3 different resolutions prevents you from acting on false signals generated by a single isolated time frame. For now, ignore the daily and 4-hour charts. Focus your attention exclusively on the weekly pane. This acts as your guiding macro compass. We are looking for clear market structure. Notice how the price consistently forms higher highs and higher lows, tracking comfortably above our moving averages. This establishes an unbreakable rule for the rest of the setup. If the weekly chart is trending up, we only have permission to look for long or buy positions. Following this strict weekly bias protects your capital. It stops you from buying into a market where the heavy institutional volume is already moving in the opposite direction. Now that we have our direction, move to the middle pane, the daily chart. Buying right at the peak of a weekly rally exposes you to immediate, painful drawdowns. Instead, we wait. We need the daily price to pull back, temporarily dropping against that main weekly trend. We are waiting for the price to drop into a recognized support level. Often, this happens exactly where previous resistance flips to support, or where the price taps the 50 exponential moving average. That specific intersection creates our value zone. If the price is outside this boundary, there is no trade. Waiting for this daily drop means you are entering at a discount rather than chasing an overextended rally. This mathematical patience directly shrinks the distance to your eventual stop loss, improving your potential reward. Finally, move to your third pane. Zoom completely into the 4-hour chart, restricting your focus to the price action happening strictly inside that daily value zone. Here, we hunt for the trigger. We want to see a specific bullish candlestick pattern, like an engulfing candle, forming directly on our support line, showing us that buyers have re-entered the market. Check your oscillator for secondary confirmation. Your 4-hour RSI needs to show a clear bounce upward out of oversold territory. You do not buy while the candle is forming. The trade only becomes active the exact moment that 4-hour confirmation candle officially closes. Attach the long position tool to the closing price to see the math. Pull the stop loss below the recent swing low to give it room to breathe. Drag the take profit up, ensuring the reward box is 3 times larger than the risk. Now apply the golden rule of position sizing. Calculate your lot size so that if the price hits your red stop loss line, your account only drops by a maximum of 2%. Strict adherence to this 1-to-3 ratio and a 2% risk cap creates an enduring statistical advantage. You can actually lose over half of your trades using these exact criteria, and your account will still consistently grow. You have a context-backed trend, a precise value entry, and automated protection. Click Execute. The system is live. 4-hour setups require a great deal of patience. You can expect this specific trade to take anywhere from 3 to 7 days to hit either your stop loss or your target. The most common failure point right now is chart hopping. You will feel an overwhelming urge to drop down to a 15-minute chart to scrutinize every minor red candle that prints against you. You must resist that urge. Close your platform, let the 4-hour candles execute the probability mechanics exactly as you mapped them. Enduring success in the markets requires executing a predefined system with total discipline, letting the math do the heavy lifting. If mapping this strategy gave you a clearer view of the charts today, hit subscribe and let's build your next trade.